Well, are we in a recession or are we not in a recession? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it, and I do have a line open if you'd like to call in. The number to call is 1-877-913-5357, 1-877-913-5357. You can also go to the website at www.prudentmoney.com. Send a question into the Ask Bob section, and we'll get you taken care of. That's all at the website, www.prudentmoney.com. 1-877-913-5357. Well, I want to get you caught up on matters we've been talking about regarding the economy and whether we are in a recession or we are not in a recession. Let's look at what the definition is of a recession. Definition is two back-to-back negative economic growth quarters. So you have every quarter you either have positive economic growth or you have negative economic growth. And the first quarter of the year, we had surprisingly, because all the economists come in and they decide what their percentage growth or loss is for the quarter, they average it all together, and it was a pretty healthy growth rate for the economy that they were forecasting was going to happen, and it was actually a negative number, meaning that the economy did not grow, it lost some of its growth in the first quarter. So that immediately makes a shift to the second quarter. And the question is, will there be growth, positive growth in the second quarter, making the first quarter's lack of growth not an issue? Or will it be a negative growth during the second quarter, giving us back-to-back quarters of negative growth, which would be the accepted definition of a recession? Of course, we got that number on Thursday, and we did actually have a negative growth number for the second quarter, giving us back-to-back negative quarters of economic growth, which is a recession. So I happen to have on CNBC on my computer. I was watching it live. And CNBC, for those of you who don't know, is a financial media company that is round-the-clock financial news and commentary. And they had the four analysts, main hosts on the program that morning. And it was amazing to me as I watched, and I listened very carefully because I try to get what the hidden meaning and the hidden message is out of all of this, because we are, after all, dealing with media. And they were going as hard at it as you possibly could to convince the viewers that there was no way that this is a recession. They were going through all the metrics and the decision points and the factors and the indicators, and they said, there's no way this is a recession. Yeah, this second quarter will be positive. And sure enough, it came out and it was negative. Well, immediately, the main host, the senior economist, he says, well, we can't count the first quarter as a negative quarter. The results of the first quarter don't count, so we've only really had one negative quarter, not two. I thought that was interesting, as he just decided to change the definition, a definition that we've gone by for a long time. And then there was the also the concern that we're entering into a period of stagflation. Now, stagflation is a fancy word for inflation and a recession happening at the same time. Just think the 70s. Immediately, one of the other CNBC hosts says, well, since inflation is under control, there's no more stag and stagflation. I don't know what numbers he's looking at, but the last number that I saw for inflation was a higher number, number one. Number two, there's no indicators that are even remotely suggesting that the inflation is, that we've got a hold on it. So I don't know where he was getting his math from. But it was just interesting to me because why is the agenda to discredit any the information coming out about the economy? And I thought about it for a second, and of course there's a couple of reasons why. First of all, it's a little bit more stock market friendly, and they're always there to look at the brighter side of things in order to give investors on Wall Street an encouraging report to keep the market going up. So there's that. But there's the other thing too, is that a little bit liberal leaning station, CNBC, and maybe it's because they want to discredit any type of potential recession that could actually hurt the Democrats in the mid-year elections in November. Maybe I'm reaching. I don't know. But it was interesting. So there was that. Market went up, had a big day. Question is, why did the market go up if we are quote unquote officially in a recession? And there's a big bureau that actually documents the beginning and the ends of recessions after the fact. Go figure. But anyway, so it doesn't matter what anybody's opinion is. It's whatever their opinion is, and that's next year probably before we hear what they think is going to happen. But why did the market go up? Well, the market I think, was actually expecting there to be a negative quarter. And when the market gets an expectation, as long as that expectation comes through and as the market thought, goes up and everything's fine. It's when the market is surprised that things are not good. So if we would have had, say, a real deep negative growth number, that would have been a very market unfriendly number and a problem. So that was the first thing that happened, and I think that happened on Thursday. The day before, on Wednesday, the Federal Reserve Board raised interest rates 0.75%. Market went up on that as well. And there's a couple of reasons why the market went up because of that. The first one, remember, there's a big difference between what the Fed does and what the Fed says after the Fed takes an action. So said another way, is the Federal Reserve Board announces its decision on interest rates, up or down or stay the same. Then they hold a press conference and they talk about what the meaning behind their interest rate hike was, what they plan on doing. They basically give the market some peace of mind or some additional anxiety, one or the other. That generally happens a little bit later on in the afternoon. Well, there seemed to be a little bit different tone with Federal Reserve Board Chairman Jay Powell, that maybe he's not going to be as aggressive. Of course, that's market friendly. The market went up and had a big day as well. But the thing that you got to remember, and the question is what the Federal Reserve Board doing actually working? Now, we went through 2 or 3 months of the Federal Reserve Board raising interest rates and the bond market getting tossed out on its head. What I mean by that is, remember, there's a correlation, an inverse relationship between interest rates and bond prices. As interest rates go up, bond prices go down. As bond prices go up, interest rates go down. So this was what happened much of the year until about mid-June. Then it changed, is that interest rates were going up, bond prices were going down. That's why your bond fund lost so much money this year. And interest rates went so high that mortgage rates went up to the mid fives, 5.5% to 6%. I think it was as high as it went. Now, ever since June, since the Fed got real aggressive with 3/4 of a rate interest rate hikes, interest rates in the bond market fell. In fact, today, where they were at 3.1, 3.2%, today they were at 2.6%. They've fallen dramatically. So what the Federal Reserve Board is doing with interest rates is not necessarily working, but it doesn't matter because there's probably a hidden agenda behind all this, because the bottom line is the Federal Reserve Board could never raise rates high enough without taking the economy to take care of inflation. That's just that's my opinion, but it's pretty close to the truth. It'd be hard to discredit that. 1-877-913-5357. This is Bob Brooks. Stick around. Be right back. Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. 1-877-913-5357. Well, an interesting story caught my eye as we debate this, are we or are we not in a recession, involving a company named Olympia Sports. Now, Olympia Sports is a sportswear manufacturer, I guess you call it. They sell sportswear and sporting goods. This news release came out, and the only reason this news release, I think, came out is because this was posted all over their website. But it says Olympia Sports has decided to close all of its stores, according to a brief posting on its website. The company provided very little detail other than saying that all locations are closing and all sales are final. Now, this company has been around since 1975, has survived the economic shock of inflation in the 70s, has survived the recession in 2002, 2001, 2002, they survived the financial crisis and that recession. And here we are. I guess the trends in retail, of course, had something to do with it, but that's not my point. The trends in retail, the Amazon effect, I'm sure had something to do with it, and the competition maybe just got to be too much. But retailers just don't shut down, having been in business for 1975. They file bankruptcy protection. They reorganize. They first start off shutting down, some of the 70 locations so that they can save money and cut their expenses. But apparently, there's only one other company that just went out of business completely. Of course, it's a little bit different, totally different than a sporting goods store. But that's what happened to Lehman Brothers. They literally ran out of money. And it looks like that could have happened here to Olympia Sports. Like I said, they didn't take any of these measures that you typically see retailers take before they just call it quits. I mean, they could have closed down 60 stores and kept open their 10 best ones and tried to make it through whatever they were facing. But now they just closed them all down. No stories of bankruptcy or anything like that. And then that's it. Now, ladies and gentlemen, that's what happens in recessions. That is exactly what happens in recessions. Foreclosures took off. The recent number of foreclosure starts, which is when the first public foreclosure notice happens, is up 219% since the start of the year. The number of properties that had foreclosure filings, which includes foreclosure starts, is up 153% from the same time period last year. Now, keep in mind, a lot of this is from very low levels. That's where you get your really big percentage numbers and that type of data. And the untold story here are these forbearance programs and the fact that they've all come due. They're all taking their toll on these homeowners because the homeowners have got to pay this money back, and just causing all kinds of problems, and to the point that they can't hold on to their property. But the bigger story is that these are people who have a lot of equity built up in their house, that they could use that equity if they could restructure their mortgage loan to use that money to pay off the forbearance loan the forbearance. But the catch-22 is they have to have the forbearance paid off before they can go through and refinance a note. Now, this is not doing anybody any favors, and you would think that the government would step in. It's funny, they stepped in and changed things and implemented programs and did all this during the pandemic when there was a crisis. Now, this to me is a crisis from the answer that the solution they tried to bring to a crisis, which you could see this writing on the wall that this potentially is going to happen. So why wouldn't the federal government work with the banking system? I mean, the Federal Reserve Board controls the banking system, and these homeowners who've got the money in their house as equity in their house, they could I mean, this just if it's maddening. I hope you get what I'm saying on this. They've got the money, it's just tied up in their house, and they can't refinance, take the money out, and pay off the note because the note exists. And why the greedy banks would rather foreclose on these properties because they're taking the money, I mean, the equity they've got this money built up. In most foreclosure situations, you don't have equity in the property. But just sign of the time, and this is something that's really not getting a whole lot of press. So we look at these foreclosure numbers, and of course the real estate industry is saying, "Oh, this is no big deal." I think the equity deal is a big deal. Losing your home when you got equity in your home to pay the forbearance back, but that's unbelievable. Let's say it's no big deal because it's still way below average. Well, is it below average and catches up to normalize, or does this really become a problem? Who knows? I mean, this is not a situation like the situation was in 2008. The financial crisis that occurred in 2008 was about toxic loans, toxic mortgages. The story this time is not about toxic mortgages that could bring the system down. It's a pretty horrible story about the way people who could have paid back really call it a debt, could have had the banks worked with them anyway. What do the banks have to lose? They still, I mean, if they wanted to foreclose, say that you owed $30,000 to the forbearance program, you've refinanced the house, you had $30,000 in the house in equity, you took the $30,000 out, you paid it off, then you went into foreclosure a second time, and the bank took your house. They still got 20%, and they're probably selling it over list because there's tons of people that are still willing to buy houses. Go figure. But that's the kind of weird stuff that you see in a recession. Now, what this does, these interest rate hikes, kind of jumping around on you a little bit. The interest rate hikes, and we talked about this a little bit last week, definitely raises the average interest rate on consumer credit cards. So for all credit cards, the average interest rate in the first quarter of 2022 was 15.13%. For cards accruing interest, the average in the first quarter was 16.65%. Get this. For new credit card offers, the average credit card today is a whopping 20.82%. Now, what is shocking about this number is some of the background material that I read that had these interest rates in them. The background material was the writer was talking about what a great thing, credit card debt is strong, credit balances are strong. People are using credit again. Using credit at 20.82% is a recipe for disaster if you can't pay it off. I mean, we're talking about high interest rates, high debt service in a scenario where people are getting squeezed by inflation, which a lot of these stories, once again, are not hitting the media. But be really careful. We'll talk about this tomorrow, about some of these quote-unquote good deals credit card companies are launching, because what you may be replacing, even at 0% interest for 12 months or so, may end up being a much worse interest rate than what you have now. And you've got to be able to know that to make good decisions, because you don't want to get yourself into a worse situation because you were able to secure 0% interest for 12 months or whatever the deal was. So you want to definitely be careful. We'll talk about that a little bit tomorrow. This is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.